Today on Forbes, Bitcoin's crash is putting crypto treasury stocks to the test. Crypto is back in the gutter. Bitcoin has been below $70,000, down roughly 50% from its October highs. And the pain is sharpest for a new class of public companies that spent 2025 reinventing themselves as crypto hoarders, the so-called digital asset treasuries, or DATs. There were more than 200 of these firms, collectively sitting on roughly $150 billion in crypto at the end of 2025, comprising an entire mini-industry modeled after Michael Saylor's Strategy, the $44 billion market cap Bitcoin buying behemoth that transformed itself from a small, forgettable software company into the corporate champion of adding Bitcoin to your balance sheet. But even before the latest leg down, many DATs were already trading at discounts to the market value of their crypto. Now that tokens are sliding again, these stocks are falling faster than the assets they hold, racking up paper losses and making it harder to follow the Saylor playbook of continuous crypto buying. Data provider Artemis estimates DATs are down more than $20 billion in aggregate. Strategy alone reported an operating loss of $17.4 billion in Q4 2025, and its stock is down nearly 70% over the past 6 months. Bitmine Immersion Technologies, an Ethereum Treasury analog based in Las Vegas, is sitting on $8.1 billion in unrealized losses, with its stock down a similar 66%. While these companies have managed to keep their market to net asset value, or MNAV, ratio, indicating a premium/discount to underlying crypto holdings, near or slightly above 1.0, dozens of smaller DATs have fallen to deep discounts, not only making it difficult to raise fresh capital, but also calling into question their whole raison d'etre. Marius Barnett, chairman of SWI Group Holdings, a digital asset treasury firm focused on the SWI cryptocurrency, says that many of these, quote, treasury firms simply didn't have the strategy, but were really opportunistic trades. In theory, lower prices should be the perfect setup to buy more Bitcoin, Ether, Solana, whatever your mandate is, at a discount. In reality, a lot of these companies loaded up near the top, didn't manage cash conservatively, and now don't have the flexibility to keep buying. This inevitably leads to selling pressure. If enough DATs unwind their positions, it's not hard to imagine token prices declining further, leading to more losses. In one of the recent examples, ETHZilla, a Palm Beach-based Ether treasury, has recently sold a portion of its $139 million ETH holdings to buy 2 aircraft engines for $12.2 million, then lease them to an unnamed major airline for about $90,000 a month, according to the company. But CEO McAndrew Rudisill says the volatility doesn't bother him. He says, quote, "We've been pretty proactive about both staking the Ether and managing our exposure, and we've always talked about tokenizing real-world assets. Our focus was always to get to a point where you're generating revenue and cash flow using the asset, and that's where we are now." ETHZilla, which was known as 180 Life Sciences Corp before it caught crypto fever, is also planning to tokenize mortgages for modular homes, where Rudisill claims default rates are low. Today, many DATs look like screaming bargains, given that their underlying crypto would seem to be trading for as little as 13 cents on the dollar. Moreover, many of the larger names, like Strategy and Metaplanet, have avoided pledging their crypto as collateral, so they don't have to sell out their treasuries to cover obligations. Enticing as the discounts may seem, don't count on them narrowing anytime soon, unless crypto soars again and DAT momentum resumes. Many have predicted a wave of consolidation for corporate crypto holders, but digital asset treasury deals are difficult. Christian Lopez, managing director at Cohen & Company Capital Markets, says, quote, "I think it's really challenging to do M&As, at least right now. One, everyone thinks they're undervalued. They may or may not be. Theoretically, if I'm trading at like 0.8 MNAV and you're trading at 0.9 MNAV and you acquire me for 0.85 MNAV, that's technically accretive for both sides. So on paper, it kind of makes sense. But then you start to run into shareholder and governance issues. For full coverage, check out Nina Bambasheva's piece on forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.